Alrighty. So today we're going to be talking about the triple income option strategy, which is the wheel strategy. Now I already created a video previously on the wheel strategy, but today for this video we're going to go a little bit more in depth, and I'm also going to be sharing with you an advanced concept that can also help you increase your profits from the wheel strategy. So let's do a quick recap on what the wheel strategy is, right? So the wheel strategy basically starts off by selling a cash secured put with the objective that we want to get assigned on this 100 shares, right? So once we get assigned on the 100 shares, we're going to sell our covered call. And then on the covered call, we want to have our shares called away, and then we will go back to selling the cash secured put again, and we'll do this over and over again. So basically, this is the wheel strategy. Now, in the previous video, I talked about only these two income sources, basically just to get a premiums from selling cash secured put as well as the covered call. So for example, this is the stock right now, and then we'll be selling an out of the money cash secured put. All right, cash secured put, and then the market hopefully was to go below the cash secured put, and then we'll be assigned on this cash secured put. So we'll be now long 100 shares, and then we'll be selling a covered call at the very same strike price, so that when the stock goes up, and then we'll be assigned on the covered call. That means our 100 shares will be called away, and this way we'll be back to square one again, where we sell a cash secured put again. So in this case, we do not make anything on the shares because we are essentially buying and selling at the same price. The only income which we'll receive is from selling the cash secured put and the covered call. But for this video, we're going to be talking about the third income source, which is capital gains from stock. And usually the gains which you get from the capital gains of the stock would be higher than the premiums which you receive from selling the cash secured put and the covered call. So basically it will be something like this. So this time, right, we'll be selling a cash secured put, still out of the money as well, but this time as the stock goes down, now we get exercised. Now we are long 100 shares. So this time, instead of selling the covered call at the same strike price, we're going to sell our covered call above our entry price for where we are long the 100 shares. So this way, when the stock goes up, all right, we will be assigned on the covered call, so 100 shares will be called away. So we'll be making money on the cash secured put, making money on the covered call, and we'll be also making a capital gains, right, from our underlying stock as well. So when you're selling the cash secured put, we are basically earning extrinsic value, right? Because we're selling out of the money put options, and for the covered call, we'll be selling out of the money call options. So this too will be extrinsic value. But the capital gains from the stock, this would be intrinsic value, because in a stock position, 100 shares is always 100% intrinsic value. So in this triple income option strategy, we'll be having a very good mix, a very good profit mix of extrinsic value and intrinsic value extraction. So what makes the wheel strategy profitable is only if you choose the right stock. So this has been quite a pretty hot topic for a lot of people, especially they have been asking me quite a number of times, how do you choose a stock for the wheel strategy? So I want to spend some time on this section so that you can understand my thought process when it comes to selecting stocks. So for me, the first thing I always do when it comes to any strategy in the options, when I trade any options, I always choose stocks that I don't mind owning for the long term. And that means that these are stocks that I believe will go up in the long term, as opposed to just going for stocks that gives you high premium. Right, so there are a lot of option traders out there. They are mainly trading those high volatility stocks, right? These are stocks like your GameStops, AMC, a lot of those meme stocks, right? So if you were to go with those kinds of stocks, yes, you can get high premiums, but the problem is that you may not necessarily be able to get the wheel strategy to be profitable in the long term, because right, a lot of these meme stocks, they aren't actually profitable. Right, so they do not have increasing revenue, do not have increasing profits. So the problem with such stocks is that, let's say for example, you sell the cash secured put down here, right? So as we all know, we want the stock to go down, and then we sell our cash secured put, right? So our cash secured put is gone, we want to sell our covered call here. But the problem is that, what if the stock doesn't recover, right? It goes all the way down. So now you are stuck with 100 shares and your covered call expires worthless, and then now you cannot get out of this position, Right, so while you may have a lot of a premium from selling your cash account put and your cover call, you still wouldn't make money at the end of the day. You can close out a position if you cannot get out of this 100 shares, right? So a lot of these meme stocks tend to have a little bit of that risk baked in because of the fact that they aren't actually profitable. So I would rather go for stocks that do not have as much volatility, that means do not give as much premiums, but in the long term the stock will always go up. So now there are a few ways to identify stocks that will always go up, right? So of course it's not a guarantee, but it's always when you talk about investment and trading, it's always in terms of probability. So the first thing that I look for in a stock is for good fundamentals, right? Good fundamental means, right, you have increasing revenue, increasing net income, and high free cash flow. So you see, a stock, the most important thing is when you choose a stock, it has to always go higher and that it doesn't go to zero, right? I mean, sounds a little bit straightforward, but the thing is that a lot of people choose these stocks with no profitability. So if a stock is not profitable, they have mountains of debt, there's always a chance that it can go bankrupt. And if it goes bankrupt, then there's no way for the stock will definitely go to zero, right? So that is why I always look to make sure that the company is profitable. So I want you to take a look at these three income statements of three different companies, right? You have company A here, company B, and company C, right? If you would just take a look at these three income statements, you don't even bother about what's their name, how the stock chart looks like, which is the company which you would rather, trade in, you would invest in, you would do the wheel strategy in, right? So the blue color bar shows the revenue, and the yellow color bar is the net income, that means the profits, right? So you can see in company A, it has increasing revenue, and it also has increasing net income. So this company has been profitable over the past 5 years. Now let's take a look at company B. All right, company B has increasing revenue, okay? But as the revenue increases, look at this, the loss also increases. So would you want to invest in a company like this? What about company C, right? Company C seems to be all over the place, right? You have revenue that is very high for the first of the 3 years in the past 5 years, and then you have a huge dip, and then it goes back up. And what about your profits, right? You have a loss here, you have a slight positive here, you have a loss here, you have a massive loss here, and another loss here. Would you want to put your hard-earned money into these stocks? Chances are that you wouldn't want to, right? Because it's pretty risky. So what are these companies? So if you were to take a look at the company charts, you can see that their income statement pretty reflects the stock price itself. So the first company is Microsoft. Microsoft has increasing revenue, increasing profits, and check out the stock price. It has been increasing non-stop for the past 5 years. In fact, for the past decade or so, even since the dot-com crash, Microsoft has always made new highs. Now, company B, increasing revenue but decreasing profits, or rather increasing losses. Look at their stock price, up and then down, a roller coaster ride. And the third stock is AMC, where you have a roller coaster of a revenue as well as a net income. So you can see you have this shoot up and then it goes back down again. So if you notice that Roblox and AMC are still very heavily traded stocks, a lot of option traders like to trade them because the premiums are high. So if you were to do the wheel strategy on this two, no doubt that you're going to get high premiums. But then what if you're caught at certain places, right? What if so happened that you managed, you entered the wheel strategy, you sold a cash account put here, and now the stock is all the way down here, right? How are you going to recover? Or it's going to take a long time to recover, if it ever recovers. And also for AMC, what if you happen to get in your cash account put down here, right? Look at this, you're going to take some time before it's going to recover again. So that is why when it comes to choosing stock, I'll go for the large caps ones, and then also I'll go for companies that have a lot of profits, a lot of revenue, and high free cash flow. Next, you want to look for strong technicals. So as you can see in the chart earlier, right, what I like to go for are companies that have gone through several market crashes and still gone higher, right? So you can go as far back to maybe 2000 or even 1987 crash. Just take a look at the chart, right? Just go to the monthly chart and see, have they been growing? Has the stock price been going higher each time? If it has, then you know that this is also a very potentially good stock for you to do the wheel strategy, because remember, the wheel strategy, it has to always go up. If the stock doesn't go up, then your wheel strategy is going to be hard for you to make money. All right. Now, lastly, what if you're not that good at finding stocks, right? You're not sure whether the stock that you've chosen is good. Well, then you can go for the broad-based index ETFs, right? Because these are a much safer choice. The index ETFs, they have a basket of stocks, right? So if a certain stock is not performing, the ETF would just rebalance them, they'll remove it out and then replace it with another stock. So a good example would be the broad-based index of the Spiders, QQQs, IWM, as well as XLF, right? Some of these have names which some of the companies did go bankrupt before, right? One of the stocks that have gone bankrupt before is Bear Stearns, Lehman Brothers. Now, these were included in some of the biggest index funds, but at the end of the day, index funds still always went higher. So if you're not very sure on what stocks to choose, you're afraid of choosing the wrong stock, then you want to go for broad-based index ETFs. Now next, let's talk a little bit about entries and exits. Alright, so the first thing we're going to talk about is selling the cash secured put. Now when I'm selling the cash secured put, we always want to have a margin of safety by entering only when the stock is oversold. So when the stock is oversold, basically this is the indicator which I use is stochastic. So when the stochastic has a reading that is oversold, then that is when I start to sell the cash secured put, because I do want to ensure that the moment if my cash secured put get assigned, that there's a good chance for the market to go back up, right? So it's much better for you to enter when the stock is oversold rather than when it's overbought, right? So because when it's overbought, there's a higher probability that the market is going to go down, right? So we want to be much more smarter and strategic in our entries, and we also want to enter when there is a support level. So I'm going to explain this later on in the chart. And the third thing that you want to do, so this is a little bit of advanced concept, which is to stagger entries into several levels, right? So if you have enough funds, so let's say for example you have $10,000 dedicated to this stock to do your wheel strategy. So instead of putting all 10K into one level, you want to split them into several levels, right? Maybe you split them into 3 levels. So you put in $3,300 for each level. Alright, so that means you want to look for stocks that are around the $20 to $30 range, right? Because when you do this, you will increase the probability of generating the triple income at lower levels, right? So for example, let's say you sell the cash secured put, okay? And the market goes up and then it goes down. Let's say it goes down and it takes a long time for it to finally come up. Right, it goes down, dwindle. So during this period of time, you can't really make anything, right? Because the stock may have gone so far down that you're not able to sell a covered call at your break-even point at the very least, right, or even higher. So you get stuck down here. So instead of doing this, you want to be splitting them into 3 different levels. So basically, what you want to be doing is something like this, right? Let's say you sell the cash secured put, first level. So once it comes down, you sell another cash secured put down here. And if the stock continues to go down, right, you sell another cash secured put. So this way, even though if the market doesn't recover, right, to the first level, at least this first few levels, you're still able to sell cover calls to try and get more profits, right, to get some profits going on down here. So I'll show you a little bit more in the charts. Now, the thing to take note is that there's a trade-off. That means that you won't make as much if the stock rallies after filling at the first level compared to one entry level. So this is what I mean, right? So let's say for example the stock was to just dip into your first level of your cash secured put, right? So let's say this is just one entry. If it comes down here, all right, let's say you are now assigned 100 shares and then the stock goes up. So perfect, everything is good down here because you only have one level. But if you had 3 levels, let's say you have another 2 levels below down here, Now it doesn't get filled on your two levels, so that means that your profit is only 1/3 of what it should be, right? Because if you had a single level, you will put, let's say, $10,000 in your capital into this level. Let's say, for example, you have allotted $10,000 for this strategy on this trade, right? But if you were to split into three levels, right, this would be only 3.3k, right, 1/3 of it, and then this will be another 3.3k, and that means you only have 1/3 of the size. As the market goes up, that means your profit is being reduced by 2/3. Right, so that is the trade-off. Now I'm going to go through some charts so you can take a look at it a bit later. Now next is selling the covered call. Now covered call, basically what you want to do is sell only when the stock is overbought and also above a resistance level. And if you have several cash secured put, you can stagger your covered calls into several levels. Now this will be on a discretionary basis, so as you see the market goes up, you can just place the covered call as the stock goes up. Now I've also created a video on the covered call, the blueprint on the strike selection, so you can go ahead and watch that. Alright, so let's get into a trade example. So this is for the single entry level, so you can get a better understanding of what I mean here. So we can see down here, what we want to do is wait for the stock to be oversold first. So as you can see down here, this is oversold, and then the market is down here. But the thing is, there's no support level here. So where's the next nearest support level? Is around this price, right? So this price is around 135. So what you want to do is you want to sell a cash account put either at this level or slightly lower than that, right? If you're more conservative. So I tend to be more conservative, so I want to sell at 130. So that's what I'll do. So I'll place a cash secured put at 130, and from this point on, what we'll do is just wait and see what happens next, right? So the stock continues to go all the way down. So indeed, it went past our cash secured put, and let's say at this point, our cash secured put gets assigned, right? We get assigned and we are now long 100 shares. So the next step, what we're going to do is we just have to wait for the market to go back up a little bit first so we can start selling the covered call. So at this point in time, the market went up. Now there is an overbought, right? You can see it's overbought on the stochastics. So this is where we want to sell our covered call. So down here, now when you're selling the covered call, you can of course sell at 130, right? You get more premium. But the thing is that although you get more premium, you do not get any capital gains from the underlying stock. So what we ideally want is to get a capital gain from the underlying stock, right? So instead of selling our covered call at 130, we'll be selling at 135. So this way, if the market goes up and it closes above the covered call, right, at expiration, then we'll be getting this profit down here as well. So once we place the cover call, next thing you do is just wait and see what happens. So the stock unfortunately went all the way back down again, right? At this point in time, you can see it's oversold. So now that it's oversold, there's no point for us to keep the cover call because we have probably made quite a bit of the profits or the premium that we received from the cover call. So it's time for us to close this cover call. So what we'll do is we'll go ahead and close the cover call. So at this point, we wait for the stock to go up again, wait until we receive or we see an overbought signal, and then we sell our cover call again. All right, so this time we sell at 135 again. And then subsequently, you can see the market gapped up, although on a very negative or rather not so good earnings. As you can see down here, the market did gap up, and then at this point in time, we just wait to see whether we are assigned on the cover call. If we are assigned on the cover call, that's good, right? Our shares get called away, and then we can sell our cash secured put. Basically, just wait until the stochastics go down again, and then it becomes oversold. We can sell our cash secured put. If it doesn't get us called away, it goes down here, back down again. What we can do is we can sell another cover call, and then just wait again. Right, so basically this is the single entry level. Okay, now what about multiple entry levels? So this is what I mean. So instead of placing one cash secured put, we will be selling multiple cash secured put as the market drops. Now remember, there is no difference to the risk allocation, right? In the single entry level, if you had $10,000 allocated to that stock for the wheel strategy, then you'll be putting all $10,000 for the cash secured put, right? That's assuming $10,000 is also part of your portfolio size, right? Maybe you have like $100,000, right? Let's just say, for example. Now, for the multiple entry levels, if you have allocated $10,000, you do not change the amount. So instead of putting, $10,000 to one of this, right? So Now in this case, realistically, because this stock Amazon is 12,000 or $13,000 if you were to get filled on this, so realistically you need about $40,000, right, for 3 levels. So instead of $40,000 you put into one level, what you want to do is to split them into multiple levels. So this is how it works. Again, you can see this is oversold. Alright, so you'll be selling your cash secured put on the first level, then we'll wait for it to see what happens. So at this point of time, the market went down. So when it goes down below the first cash secured put level, now we can sell a second cash secured put level. Now, where do we place the second cash secured put level? We're going to put it roughly around 5 to 10% apart, right? So in this case, it's close to 10%. So let's take out our calculator here. So let's see what do we have down here. So it's just 15 points, right? So 15 points from 130 to 115 divided by 130. So this is roughly 11.5%, right? So it's 11.5% difference from here to here. Okay, so we're going to be selling a cash secured level 2 at 115. So once we sold this, we wait and see what happens. So as the market drops even lower, we now sell our third cash secured put level, right? So level 3. So we split our allocation for this stock to 3 levels. So after these 3 levels, we do not enter anymore. If the market subsequently goes all the way down, what we're doing is we'll be holding on to the stock until it finally recovers, right? So once we have sold this cash secured put level 3, now what we do is just wait and see what happens. So let's say at this point in time, let's say we are now assigned on our cash secured put level 1, right? So now we are long 100 shares at $130. So at this point in time, there's nothing to do. We just wait and see if the market goes up or goes down. So at this point in time, the market goes up. Now it is overbought. So what do we do when it's overbought? That's right, we sell a covered call. So as you can see, we sell a covered call at 135. Right? So this time we can get a capital gain in case the market does go up and then it closes above our cover call, and if it does, cash secured put level 2 and level 3 would expire worthless. This way we'll be able to gain the full premium which we sold it for. So let's see what happens. So in this case, the market went back down. So as it went back down, what do we do once we see that it's oversold? We can close our cover call. So we go ahead and close our cover call, and let's say at this point our cash secured put level 2 has been assigned to us, right? So now we are also long 100 shares at 115. Now when we do this, we want to ensure that we see them as 2 separate orders, right? 100 shares here and 100 shares at this point, because we're going to be selling cover call separately for these 2 different levels, right? On your platform, they may merge it as one order, right? They will take it as 200 shares and they will take the average price at probably around 122.5, right? So you need to keep a log of this on your spreadsheet so you know exactly where you went long. Okay, so at this point in time, cash secured put level 3 has still not been breached. So at this point in time, this is still considered out of the money. So let's see what happens next. So let's say, for example, at this point in time, our cash secured put level 3 is now expired. So now when it's expired, what do? We can always sell another cash secured put down here. So we sell a cash secured put. Let's take a look at what happens. Now that it has gone up, right? Again, now we have this overbought signal. What do? Now we sell covered calls. Right now we sell cover calls. Now we can sell 2 cover calls because we have 200 shares. We can sell a cover call for this, and we can sell a cover call for this. So remember, as I mentioned earlier on, we can stagger our exits just as the same way we staggered our entries, right? So we can stagger our cover calls on the way up. So in this case, you may want to sell a cover call at 135, and then you can sell a cover call at 140 as well, and then just wait and see what happens, right? So in this case, as you can see, if the market goes up and it closes above this 2 cover calls at expiration, then we're going to have this 200 shares called away. So we're going to be making a lot of profits in this case, right? Because we'll be making the premium from the cash secured put which we sold from down here, cash secured put here, and the 2 cash secured put that we sold down here, right? We sold 2 cash secured put down here, and in this case we'll be also receiving our cover call profits from this, and where we sold one earlier when the market went up somewhere down here. We sold one cash covered call down here. At the same time, we'll be getting our intrinsic value gain from the underlying stock, our capital gains, right? So maybe this will be considered the intrinsic value gain, the capital gains from this price to this price, 115 to 135, and then for this from 130 to 140. So this will be the capital gains here. So as you can see, when you split them into multiple entry levels, yes, there's more things to do, but it also means that you have a higher chance of more profits, right? Because you no longer get stuck in a position compared to before, right? Before, if you had just only one order at this price, if the market just stayed below down here and does nothing, you pretty much, for a period of, let's say, from May all the way to maybe even August, right, there's really not much you can do in terms of selling that much premium or even getting any intrinsic value gain, because the market has always gone below the entry price of where you got long 100 shares, right? But then if you were to split them into multiple entry levels, you can see that it's much easier for you to gain on any of this, right? So let's say in the event if the market did come down here and then now you're long 100 shares, guess what, right? If this gets up here, down here, you can start to sell another covered call. So you'll be making profits at the bottom level first. So even though if the first two levels have no chance to get any intrinsic value gain from the underlying stock, your last level can always have a chance for you to gain the intrinsic level. And let's say the market just bounces back and forth at the bottom, right, for a long time before it eventually goes up. Then guess what? Then your third level will always be making the cash secured put, and then the intrinsic value from the stock as well as the premium from the covered call. So you have the triple income just on the last level alone before you can gain the triple income from the other two levels. Alright guys, this is quite a little bit to take in, but I want you to go back and rewatch this part again if you're not very sure. But this is a very good way for you to ensure that you're always getting something as the market is moving, right? As the market goes up and down, especially if it continues to go down, right? If you split them into multiple entry levels, you're ensuring that you're always getting an income at the lower levels. If you were to just keep them to just one level, just like the earlier example which I showed you, just for example, if you were to just sell this level, just level 1 without anything else, then if the market goes all the way down here, you're not going to be getting anything, right? So it becomes much more strategic, much better in my opinion, if you have enough funds, of course, to split them into multiple levels. Alright guys, so that's it for this video. I hope you have enjoyed it and found it helpful. If you have, please subscribe, give me a thumbs up for this video, and as always, I thank you for watching, appreciate your time, and may the options favor you.